Right now, silver is not acting like a market that's ready to roll over cleanly. It's acting like a market that's testing patience. I am going to begin by unpacking why most people ask the wrong question about silver, focusing on price instead of pressure. I will then walk you through, in clear everyday language, how silver quietly signals its next move, long before the chart ever looks scary or euphoric. After that, I will connect the past 2 weeks of economic and social stress to silver's behavior, showing how forces that never mention metals still end up moving them. I will close by reframing what a real silver top actually looks like, because it almost never feels obvious when it's happening. Stay with me until the end, because I'm going to show you exactly when to make your move into silver or run for the exit door. Now, before we go any further, a quick pause. If these breakdowns help you actually see silver instead of react to it, hit subscribe and drop SilverBug in the comments. This channel exists for people who want clarity instead of noise. We're watching how markets behave before the headlines explain it. It just takes 2 seconds to hit that subscribe button, and it really helps our channel grow. The most common mistake people make when asking when silver will drop is assuming that price itself is the signal. Price is not the signal. It is the result. Silver does not fall because it looks expensive, and it does not rise simply because people are excited. It moves when the balance between availability, urgency, and confidence shifts. Over the past 14 days, silver has not behaved like a market preparing to release pressure. It has behaved like a system absorbing stress and redistributing it through price. That distinction matters because markets under stress do not unwind neatly. They either resolve slowly through changing behavior or violently through repricing. If silver were about to meaningfully drop, you would expect to see relief somewhere in the system. You would expect inventories to stabilize. You would expect buyers to hesitate. You would expect sellers to grow confident. Instead, what we've seen in late January 2026 is the opposite. Silver has remained bid even during pauses. Pullbacks have been shallow and short-lived. And perhaps most importantly, participation has broadened rather than thinned. Markets near major tops usually feel lonely. Markets in the middle of repricing feel crowded and uncomfortable. Over the past 2 weeks, silver has traded well above $100 per ounce and pushed into the high teens beyond that level. In the final days of January, prices hovered near $120, compared to levels under $80 just 1 month earlier. That is not a typical cyclical move. It represents a roughly 50% increase in a matter of weeks. Moves of that magnitude tend to invite aggressive selling if participants believe supply can easily meet demand. The fact that such selling has not materialized tells us that price is not outpacing perceived scarcity. To understand why, you have to stop thinking about silver as a single market and start thinking about it as a junction point. Silver sits at the intersection of finance, industry, and trust. When trust in financial systems weakens, silver benefits. When industrial demand expands or becomes inflexible, silver benefits. When supply chains tighten, silver benefits. Over the past 14 days, all 3 forces have been present to varying degrees. Socioeconomic tension has quietly increased. Market participants have been digesting renewed uncertainty around interest rate policy, government debt sustainability, and global trade alignment. None of these issues directly reference silver, yet all of them feed the same instinct: reduce dependence on promises and increase exposure to tangible assets. Gold absorbs the first wave of that instinct. Silver absorbs the next, but with far more volatility because its market is much smaller. When capital moves even modestly in silver's direction, the effect is amplified. At the same time, industrial demand has not meaningfully retreated. Silver remains embedded in electronics, electrification, grid upgrades, and advanced manufacturing. These sectors do not pause simply because input prices rise. They adapt slowly, redesign cautiously, and hedge where possible. That means higher prices do not instantly reduce demand. They often lock it in temporarily. This lag creates windows where price can move sharply before demand responds. Over the past 2 weeks, there has been no evidence of sudden industrial demand destruction. Reported exchange inventories in the U.S. have hovered around 418 million ounces, near the lower end of the range seen over the past year. Against a backdrop of persistent global deficits, that level does not represent comfort. It represents vulnerability. When inventories trend lower while prices rise, it signals that stockpiles are being used to balance demand rather than accumulating as buffers. Markets in that condition rarely experience gentle declines. They experience sudden air pockets only when demand collapses, and there is no sign of that yet. This is where many investors misinterpret volatility. Sharp moves are often mistaken for instability, when in reality, they can reflect a market struggling to discover equilibrium under new constraints. Silver's volatility has increased not because confidence is evaporating, but because certainty is. Participants are less sure they can buy later at better prices, and less willing to sell now without a premium for replacement risk. That dynamic creates whipsaws, but it also creates higher average prices over time. If silver were preparing for a sustained drop, we would see changes in behavior before we saw changes in headlines. Retail premiums would compress. Delivery times would shorten. Forward pricing would flatten or invert. Options markets would price rapid downside rather than extended movement. Over the past 14 days, those signals have not aligned with a bearish thesis. Instead, forward curves have adjusted upward, and volatility pricing has reflected expectations of continued movement rather than imminent collapse. By late January 2026, cumulative silver market deficits since 2021 were approaching 820 million ounces, with the most recent annual shortfall estimated near 95 million ounces. Those figures are not abstract. They represent metal that was consumed, stored, or hoarded rather than replenished. Deficits of that scale change how markets behave. They shift the role of inventories from surplus to shock absorber. Once inventories are perceived as finite rather than abundant, price becomes the primary tool for rationing access. Another common misconception is that silver drops when it becomes too popular. Popularity alone does not end bull markets. Saturation does. In late-stage bubbles, everyone who wants exposure already has it, and incremental buyers disappear. That is not the current environment. Over the past 2 weeks, participation has broadened, not peaked. New products, smaller contract sizes, and increased media attention suggest the market is still onboarding participants rather than exhausting them. Tops form when enthusiasm has nowhere left to go. This move still appears to be attracting new interest rather than recycling old conviction. Socioeconomic stress over the past 14 days has also reinforced silver's role as a hedge against systemic uncertainty. Concerns about sovereign debt trajectories, geopolitical alignment, and policy credibility have not resolved. They have compounded. When uncertainty stacks rather than clears, markets tend to favor assets that are no one else's liability. Silver, despite its volatility, fits that role more than most people expect. Its price action reflects that uncomfortable duality, volatile but increasingly strategic. Importantly, silver does not need perfect conditions to keep rising. It merely needs conditions to remain imperfect. As long as supply remains constrained, demand remains sticky, and trust remains uneven, silver has structural support. A meaningful drop would require at least one of those pillars to weaken decisively. Either supply would need to surge, demand would need to collapse, or confidence in financial systems would need to improve sharply. Over the past 14 days, none of those shifts have occurred. In fact, supply remains stubbornly inelastic. Most silver production is a byproduct of mining for other metals, meaning higher silver prices do not automatically lead to higher output. Mining projects take years, not weeks, to develop. Recycling responds slowly. That leaves inventories and price as the only short-term adjustment mechanisms. When price rises faster than supply can respond, the market is signaling constraint, not excess. The $100 level has now become psychologically irrelevant to the direction of travel. What once seemed extreme now functions as a reference point. Markets often accelerate after such transitions because anchoring breaks. Participants who waited for confirmation now feel pressured to act. Participants who sold expecting rejection feel pressure to re-enter. This feedback loop can persist far longer than expected, especially in markets with limited float. Over the past 2 weeks, silver has demonstrated an important behavioral trait: resilience after gains. Each pause has been met with renewed buying rather than relief selling. That pattern suggests that holders view silver less as a trade and more as an allocation. Allocations change slowly. Trades change quickly. When a market transitions from being traded to being allocated, price behavior shifts accordingly. None of this implies that silver will never drop. It will. Volatility is intrinsic to the metal. But meaningful declines tend to coincide with visible easing of stress, not simply high prices. When inventories rebuild, when industrial buyers step back, when macro uncertainty fades, and when forward markets flatten, then caution is warranted. Until then, price alone is a poor guide. So when will silver drop in price? Not when it looks expensive, not when headlines turn breathless, and not simply because it has moved too far too fast. It will drop when pressure releases, when the system stops straining and starts relaxing. Right now, the system is still tight, and until that changes, silver's path of least resistance remains higher, even if the journey continues to be volatile, uncomfortable, and misunderstood.